Right. So guys, we are live and glad to have you guys here. And yeah, so getting started, we are here to discuss about how to make your portfolios shockproof, or is it really shockproof as of now? To have moderate this session, I am Sahil from Smallcase, and I have on board Atanuu Agarwal, who is a graduate from IIT Bombay and has worked in the investment industry across PE and VCs with Vedanta Capital that have managed well over $1 billion in AUM. He claims to take inspiration from Benjamin Graham, who is notably often referred to as the father of fundamental investing and was also the professor who taught Warren Buffett, whom of course we all know of, right? Also joining us, we have Kanika Agarwal, who happens to be a CA, All India rank 18, and also a chartered financial analyst. Before moving to public markets, she has worked with Mayfield India, managing close to $200 million in assets in venture investing across Credit Suisse and EY as well. So welcome guys. How are you guys feeling today?
Thanks, Al. All good. Excited for the session.
Right. How about you, Kanika?
Yeah, very excited to answer all these questions that users might have and hopefully add a little bit of value.
Great. Looking forward to it then. And before we get started with the investor questions, something that I really like to know about is the history behind how Upside AI came into being. And given it's literally in the name of your company, do you really think AI is better than investing than humans?
Right. So how did we start? It's always, like many times it's fate plus skills, right? Which is true for us also. Hum teen co-founders and we started this together. So, I have an investing background. Atanuu has, he's from IIT Bombay, but also has invested. And then Nikhil, our third co-founder, is, mainly technical. So he's the tech side of our, hum upside hai wo AI hai, right? So he is IIT Bombay CS, PhD bhi ki hai machine learning mein. So all of us had skills that are complementary. हमें stock market पसंद है, wanted to build something around that. So in 2017, it was almost a science project. You mentioned कि Atanuu likes Benjamin Graham, तो intelligent investor पढ़ी, and we said, okay, if Graham was starting today, or if Buffett was starting today, he wasn't 90, but he was 20 years old, he would be building rules-based things, right? Or technology-based things, because they believe in unbiased, unemotional investing. So that's really where we started, ground zero, to say, let's use machines to do fundamental investing. So when these guys came up with the idea, I said, "Ye to bilkul nahi chalega. This sounds too tough. What about management, and what about quality, and what about corporate governance?" But turns out we could build products that have great value, products that do very interesting things, and most importantly, products that remove human biases and emotions, which mean that you make superior investing decisions over the long term. So that was really our journey. Whether we believe AI works or not, wo chodo, you see the whole world and how that evolves, right? US market dekh lo, to market jaise mature hoti hai, it becomes less human run, more tech run, right? So wo US is a great example, mature market. Wahan pe there is more money now in ETFs than in active human run mutual funds. ठीक है? And passive funds or ETFs are nothing but rules based products. Similarly, if you look at even HNI money, wahan pe, right? Rich people who put in hedge funds, wahan pe top 5 hedge funds in the world are all quants, right? People who are using quantitative techniques. So that is the direction in which markets move, where they become less about humans, more about rules. So believe कि India में भी eventually होगा. So do believe कि AI rules, systemized frameworks are what deliver value over the long term. And hopefully, we're just sort of leading the way, and there'll be a whole bunch of other people who do the same thing.
Looking forward to having you setting the benchmarks and standards for AI investing in the country. And great to already have you on Smallcase. So investors already have the option right from the start to have AI-based investing in their portfolios, right? We didn't even get the chance to ask users to post questions, but we have Shibani over here who's jumping right on the bandwagon of asking right away, what is your best small case?
What is the best? Atanuu, why don't you take this, since you've built all the small cases?
Yeah, I think there isn't a best small case, right? It's what's best for you, right? That's what I think the correct question is, and the answer to that really depends on your risk appetite, right? How much risk you can take or are willing to take, right? And our three small cases, each of which do different things, right? If you look at emerging blue chip, it's a mid cap. It focuses only on mid caps, right? Which means that relatively it's a higher risk product, and the on flip side is the return potential is also higher, right? Titans is a large cap only small case, right? Which means that again, the risk and return potential both is slightly lower than emerging blue chip, right? And Shockproof, on the other hand, is a hybrid product that does equity, debt, and gold, right? And the idea behind it is to maximize absolute returns, and do by that I mean is it aims to deliver equity-like returns, but very low volatility, right? So the variation in return will be very low. So if you go and look at Shockproof's life graph, right, on the small case website, you'll see that in these last few months, when the Nifty has been very volatile because of Russia and many things, the Shockproof graph is extremely flat, right? And in fact, it's been able to deliver 10% more alpha roughly than the Nifty, right? So that's what Shockproof does. Again, the idea there is amongst the three of us, it's the lowest risk product and the lowest, and by definition, lowest return potential. So really, it depends on what you want out of a small case, right? Which part of your asset allocation it fits into. So that would be the answer. Sorry, long answer, but
no, definitely we are here for the long answers because that gives more clarity, and that is what exactly we are here for. Shibani actually also mentions that she's a salaried person having a salary of, let's say, 20 LPA. So I think what she might be asking for is having a risk appetite and actually having should she take that much risk or not, given, let's say, she's salaried and her income. So do we have any such models about, from a personal finance point of view, what is the right way to go about it? Rather, one of the questions that I actually wanted to ask you around this is, sure, we can get into how to make your investments shockproof, but how about we talk about first how to make your entire personal finance shockproof? Is there a template, or what do you guys think? How can we go about doing that?
Yeah, Kanika, you want to take this?
So Shibani, specifically, you're making good money. I'm glad that you're here. That means that you're very actively thinking about how to invest your money and how to grow your money. That in itself is a great step. Most लोग तो या तो FD बना लेंगे या savings account में पड़े होंगे. So good job on thinking so well about your money. Two, and I know Atanuu said that everything does different things. If you put money in all three small cases, you'll be pretty well diversified. थोड़ा mid, थोड़ा small, थोड़ा debt, gold, सब हो जाएगा. Which is kind of brings us to Sahil, your question, which is how do you make your whole portfolio shockproof, right? The only way to do that is asset allocation. What we mean by that is कि अगर आपके पास 100 रुपए हैं, अगर आप पूरे equity में डालोगे, you will ride equity risks. That means अगर आपने Feb 2020 में डाले थे, by March 2020, your full 100 rupees would have fallen by 30-40 rupees. Instead, if that you had taken that 100 rupees and you had put it into little bit in gold, little bit in debt, etc., your fall would have been 5%, 10%. Your 100 would have gone to 90, right? So what you do with asset allocation is to be able to stomach the losses, which means that you stay invested longer. It just increases your probability of sticking with your products and not so much how individual products do. Now, what are we all trying to achieve, right? When we say hame returns banane hain, you're not a fund manager. Your job is not to deliver the biggest returns for your portfolio. Your job is for your money to grow at a reasonable rate, which grows better than inflation, which means your savings are doing better, and then you're able to create a pool for retirement. Right? उसके लिए you don't need to do lots of fancy stuff. अगर आप साल का 10 to 15% annualized return बना रहे हो, that's amazing. That means that you'll be able to do really well. You double your money. I think at 15%, what is every 5 years?
Correct.
Atanuu?
So the rule of 72.
Yeah, 72 by 15.
Yeah. Right. So the simple answer is based on how old you are, based on how many liabilities you have, based on exactly what all you need to do, you need to essentially figure out मुझे equity में इतना डालना है, debt में इतना, gold में इतना, थोड़ा सा real estate में using REITs, थोड़ा सा आपको क्रिप्टो करना है, प्लीज not too much, not at all advising a lot of that, right? That's one part of it, but there's some basic hygiene you should be doing. One is, shock proof ke liye, make your life shock proof, right? Get a term insurance. Don't buy your endowment products, ELSS. Insurance is not supposed to be for investing. Everyone has an auntie jo insurance unko de deti hai. Don't buy the endowment stuff. Buy one term insurance. Buy a health insurance that covers you from any financial disasters because someone falls sick. Right? Make sure that you max out your PF. That's the best way to do debt. Make sure you have 6 months of liquidity in your portfolio, in your FD. Just say you lose your job tomorrow, you have 6 months of liquidity to cover your basic expenses and asset allocation. These are the 4 or 5 very golden rules. If you're following them, your life is shock proof, your finances are shock proof, and बहुत ज़्यादा सोचना भी नहीं पड़ता, right? You don't have to come every day and think about what to do.
In short, आपको राहुल द्रविड़ बनना है, अफरीदी नहीं. आपको average maximize करनी, strike rate नहीं, right? Because that is what's going to help you in the long term. Strike rate doesn't matter as much, average does.
Amazing analogies. Amazing analogies. And rather, we were here to make our investment shock proof, but हाँ, पूरे personal finance के बारे में भी how to make it shock proof हमने जान लिया है थोड़ी सी देर में. And before getting ahead, Explore Yoga Journey actually has a question. What is an AMA? So yeah, it's an Ask Me Anything session wherein investors, viewers who are here can feel free to ask any and every investing related question that you might have. Rather, as you saw, we even took some personal finance questions as well. So feel free to make the most of this session and ask away your doubts. Right. Moving forward, Tejas Joshi has a question. For backtesting, have you tested the strategies through crashes like 2008, 2020?
Yes, we have. So, we have for all of our algorithms, we have over 15 years of backtests. So from 2007 onwards, which means, and the reason for doing that was we would have done even longer. हम और भी करते थे, but unfortunately India का जो data है वो सिर्फ 2000, 2001 से available है. तो उसका मतलब है कि और हमारे algorithm को at least 5-6 साल का data चाहिए to work. So that the earliest backtest we could do is from 2007. And the good thing about that is we've seen 2 or 3 market cycles in the backtest. Right, and the one thing that I would tell you about our products is, our products are long only products. उसका मतलब ये है कि हमारे पास कोई short exposure नहीं है. And the result of that is कि when bad times happen, and this is I'm talking about our 2 equity products, and when there is a fall in the market, we will fall roughly similar to the market, and then when the market recovers, we will recover much better than the market, right? This is for Titans and emerging blue chip. And then what we've seen in Shockproof is that it does extremely well in highly volatile periods. So in the backtest in 2008, when the market was down 50%, Shockproof was only down 8%. Or during Q1 2020, when COVID hit, the market was down 30%. The product was only down 7%. Right? So Shockproof does really, really well in bad markets. And again, the idea, as I told you, was to deliver consistent returns, right? Usko consistently he wants to do well, not so it doesn't want any of the spikes up or niche, right? And the equity products, they will go down when the market goes on, but they will recover much faster, and that's why deliver superior returns.
Yeah, and you can see that live also, right? आप हमारे small case से देखोगे अभी, we went live in Feb on the platform. तब से mid caps have fallen a lot, right? And that you can see that in the emerging blue chip. But Shockproof में वो नहीं होता है, right? Titans में वो कम होता है, so it sits somewhere in the middle. So very live example of exactly that happening. So live tracks our backtest very well.
Okay. So basically what we're trying to say here is that we have 3 portfolios, and depending upon your risk appetite and how much volatility you can take in, you can choose your pill, right? Okay. Moving forward, Shibani has gratitude for us for catering to our question. Thank you, Shibani, actually, for asking the questions. It helps everyone, right? Moving forward, Ramesh has a question, and I don't know how we're going to take that, but best stock to buy. Should we look at stock specific, portfolio specific, small case specific? Your call. Please go ahead.
Yeah. So if you are, unless you are professionally managing your own money, which is your day job, okay? don't buy direct stocks unless someone is helping you make that decision. आप track नहीं कर सकते उसे रोज. So I know it has become last 2020 में सब घर पे बैठे थे, they had more time, so they could do it. It will be increasingly difficult to track what's happening. So we recommend 2 or 3 things. Within large caps, stick to ETFs or stick to the small cases, like ours. Within mid and small caps, again, trust mutual funds or small cases like ours. That's the only way you should be taking equity exposure, which is ETFs, mutual funds, small cases, PMSs, basically professional managers. If you want to buy direct stocks, maybe I won't even, frankly, maybe I don't want to say that buy a bunch of large caps and sit in it, but you should just buy an ETF if you want to buy some large caps. Would not recommend one stock. You asked me in my portfolio, I don't own any one stock. All my money is in upside products. So जो upside बोलते हैं मैं वो portfolio खरीदती हूँ, because I am not a professional manager. My algo is, and so I'm not trying to make that decision for myself कि मैं ये IPO subscribe करूँगी या मैं ये खरीदूँगी.
I think this begs the question, and especially, given that you are the experts and professionals who have been in the industry, why is investing in a portfolio better than doing individual stocks? Like, what differentiates? Are the returns higher? Is the risk higher or lower? Like, why? So yeah, that is something that people need to understand, and would love to have your opinion on that.
Right. I think the core reason is diversification, right? And I'll explain what I mean by that. अगर आप एक स्टॉक में इन्वेस्ट कर रहे हैं तो आपको let's say that stock does 20%, right, over a period of time, most likely you will not be able to realize that. So I'm saying magically someone told you that the stock does 20% over time, you are able to make that bet. Most likely you will not be able to realize the return. I'll tell you why. Because when all your wealth is in one thing, right, when it is focused on one stock or one asset, what ends up happening is that जब वो स्टॉक 20% टूटेगा या 30% टूटेगा, बिकॉज आप इतने एक्सपोज हैं उस स्टॉक एक स्टॉक पे, you'll end up making a sell decision, ठीक है, at the wrong time when the stock is actually down, and when it goes up again you'll again buy it, right? So even though the stock price technically over a long period of time will give you 20-30% return, assuming you picked a good company, your personal return will not be commensurate to that. Your personal return will be much lower than that. And this happens all the time across board. There's a lot of research कि हमारे जो inherent biases हैं उनके कारण we are not able to realize returns of individual assets. So how do you solve for that? The best way to solve for that is to diversify across stocks, diversify across asset classes, so that you are not as affected. You don't let your biases dominate your investment portfolio. Your portfolio in most times is doing decently well, right? When the stock market is crashing, your portfolio is down, but down much lesser than the stock market, right? And you are able to see that even in the medium term, your portfolio is giving you roughly moderate to high returns, right? That is what you want to solve for. Again, as Kanika said, no one here, your aim as a non-professional investor should not be to, you're picking the next multi-bagger. Your aim should be that मैं कैसे अपने पैसे को एक reasonable rate of return पे compound करूँ, and that reasonable rate of return is usually, in the range of, as we discussed, 15%, right? If you do that, I think you'll be very well off, if you do that for a long period of time.
Fair enough. So moving forward, Nirmal Murarka has a question that, can someone make a portfolio of mid caps which is also shock proof? So this is going to be interesting. Also begs the question whether what kind of stocks do you have, at least in the market cap category, in your shockproof portfolio, and if it was, would you have mid caps in that portfolio?
Yes, actually we do. So our shockproof has large and mid caps, and the way you make it shockproof, sorry to have a very boring answer, is really being able to diversify across other assets also. इसलिए हमारे shockproof में हम debt और gold डालते हैं, and what we're doing there is trying to read macro signals, try and understand inflation, interest rate, yields, volatility, things like that, and figure out if I have 100 rupees, how much should be in equity and how much should not be in equity, right? And what's non-equity should be in debt and gold. So उस हिसाब से you're able to shockproof your portfolio, right? And that is again, of course, you should be able to do it on your own at some level, and we offer it as a service also to be able to do it where you're shockproofing your mid caps.
Fair. Shibani Mathur, again, beautiful. The point being that we are revolving around the theme of our AMA, which is shockproof. And she continues that what are the name of stocks that are shockproof 3 years down the line? Now, here we could have some IP issues, but nonetheless, you can address it as you would like it to be.
No individual stock or group of stocks can be shockproof over any period of time, right? If you look at the largest companies in the world, not just India, largest companies in the world which have market caps which is close to India's total market cap, even they have fallen 10, 20, 30% in recent history, right? So what that tells you is that definitely no mid-cap stock can be shockproof, and I'll go as far as say no stock in the world can be shockproof, right? That's just the nature of equity investing, right? The reason equity gives you the returns it does is because it is not shockproof, right? So the answer is short. There is no IP there, that no stock can be shockproof, and we are definitely not in the business of forecasting returns, right? We don't use any forward-looking numbers or forecasts to build our portfolios. We are, we believe that humans, we tend to be precisely wrong when we try to predict individual numbers कि ये stock कितना करेगा या GDP growth कितनी होगी. That is very difficult to do. It is almost impossible to do. Right? So that's my short answer, but yeah, that's unfortunately I believe that's the truth.
Rather, I would like to pitch in that if you would like to know which stocks are shockproof, please go ahead and check out Upside AI's shockproof small case. Okay. Moving on, Pooja Jha has a question that it's recommended that one should not have more than 10-15 stocks in their portfolio. So first question that I would rather ask is how many stocks ideally in a portfolio is a well-diversified portfolio? The second question is, but if I have 2-3 small cases, then I end up having up to 40 stocks in my portfolio. Thoughts on how many small cases one should have? So the questions being, how many stocks in a portfolio is ideally enough to have a diversified one, and how many small cases are good enough to have? Please go ahead.
So you're absolutely right. If you are trusting a strategy, right? If you are trusting a manager, 10-15 is a reasonably diversified portfolio. As that number keeps going up, right? As you add 40, 50, 60 stocks, your return will look closer and closer to the index, like the Nifty or something. It will look very similar to what index is doing. And at that point, you can't beat a benchmark if your portfolio is too diversified also. So too concentrated and too diversified, both don't work. So from that perspective, what you should be adding is different approaches. So जैसे अगर आप 3 small cases add कर रहे हो, they should all be doing different things, right? That's why for us we have only 3 products. एक सिर्फ mid caps खरीदता है, एक सिर्फ large caps खरीदता है, और एक asset allocation करता है. So if you're buying all 3, you're putting them in 3 different risk buckets in your own portfolio also, right? And that is why we believe that too many is also too much, too little is too much. Goldilocks approach, too hot, too cold, and then there is something like just right. So accordingly, pick your small cases as well.
Got it. Tejas, moving forward, has the question that great. Thanks for replying. What was the CAGR and max drawdown for Shockproof since 2007? Is it comparable to the all-weather small case?
Right. I don't. Sorry. Go ahead.
No. If you have the numbers, please talk through them.
Yeah. So I think I don't know the numbers for all weather offhand, but what I'll tell you is that our returns are in the range of 12 to 13% in the back tests. The drawdowns were I think in the range of 15 to 20% max drawdown, right? So again, risk adjusted, if you compare it to the Nifty 50, it was 3 times better, right? But the way I'm coming up with that is I'm using a metric called Sharpe ratio. ये थोड़ा बहुत ज़्यादा technical हो गया, but Sharpe ratio का साधारण language में मतलब है कि आप अगर आपके portfolio का return X है और उसका risk Y है, तो X by Y कितना? What is X by Y, right? I'm again oversimplifying it, but so if you do X by Y of Nifty and you do X by Y of Shockproof is 3x better than Nifty over a backtest.
Kanika, would you like to add something, or do you have the numbers?
No. I think Atanuu covered it
well. Perfect. Okay. Then moving on, one lovely question that I would like to ask and I think we were discussing this before the session as well. Is there really ever a right time to enter the markets, invest in the markets? Can you really time it, or what is it about?
Right. So actually, I don't want to do some presentation or whatever, but I want to show one slide. Okay. This is live markets. This is actually, oops. Sorry, I think I made the point already. But what we're trying to do here is try and figure out over 2 years when you should enter the market. Okay. This 2 साल है, ठीक है. अभी market थोड़ा ऊपर गया. It's gone up 30% for the year. Should you buy here? It's already gone up 30%. Kya karu? Should I not? I'm not sure. No, okay, no, wait, I'll wait for a correction. But since then it went up another 30%, right? And now it's up all over 60%. What do you do now? Okay, I might as well buy now. This looks a lot like March 2020 ke baad, the next 3-7 months, right? Where market went up a lot. Now, what are you supposed to do? Should you have entered at that point? People would have waited. Falls 25%. Should you buy here? Okay, now there's some correction. Maybe I should come in. Oh shit, it's fallen another 12% from there though. Right? Okay, but it's down some more. Okay, I'll put in some more money. And then over the next 6 months, it's done nothing. It's just been flat. At this point, it's somewhere still at D levels only, at point D levels. Okay, let me put in some more money. Oops, it's fallen another 47%. So it's down 64% from point B, which is the peak, right? So now what do you do? I'm asking that question, right? It's now flat here. You have no idea what's going to happen. And then over the next 6 months, it continued to go up. So the point this is making is it's impossible to figure out. There was only one perfect time to get into the market, which is point F. Is it possible to know this point, right? Is it ever going to be something we all can do? Now, today we're already sitting at, within small caps or mid caps also, there's been a 15, 20, 25% correction across the board. What is everyone doing? Are they buying? Are they not? Are they waiting for a further correction? That's literally the graph that we're looking at. What were people doing in March 2020? All of those are really, really tough questions to answer, and which is why people should be doing SIPs. Right? Even within small cases, come in every month, come in with little amounts. And that's the only way to deliver, long-term, reasonably good returns while maintaining, some semblance of less volatility in your portfolio. So the short answer, I'm very sorry to say, is you cannot time the market. We've tried to teach machines also how to do it. And we can tell you that it's not possible. You can maybe do it once, if you're lucky, twice, if you're lucky. Consistently, it's not a scalable business model for your portfolio. So don't try and time the market. Just be, one, realistic to know that falls will happen, and two, just continue to invest. And I think most people are. If you look at mutual fund SIP flows, किसने बंद नहीं किया क्योंकि market गिरी है. सबको ये समझ में आ गया है, और इसलिए March 2020 is recent enough where they realize that they should keep coming in. Now, yeah, from this point, are we going to fall or are we going to go up? If I knew this, I would just shut shop and just manage my own money. But it's not so simple. It takes a lot of time, effort, and patience in the market.
Makes total sense, which is why that brings the question that we all got to know that there is no right way to time the markets, and you should just stay invested, or keep investing as and when you have the money. That begs the question: is investing simple? Is it easy? And if either of those, what do you think that retail investors do wrong? Where do they go wrong, which leads to subpar returns? In absolute terms, we see the index did so well, 15-17% returns. Mutual funds, small cases did so well. But where is it that where do the investors go wrong, leading to subpar returns compared to whatever benchmark they have chosen?
Yeah, so Buffett has many quotes, but one of his more famous ones is investing is simple but not easy, right? And the reason he's saying that is because I alluded to this earlier, because of how we are wired, all human beings, the way we are wired, we have a lot of behavioral biases that come in the way of returns, right? And I'm not going to bore everyone with each bias, but for example of it is loss aversion, right? Loss aversion क्या बोलता है? Loss aversion ये बोलता है कि जब आप जब आपके losses is the same as the amount of gains, your behavior is very different. So when you make, let's say 20% gain, your behavior will be a certain way, you'll be more rational. But when you make 20% losses, your behavior will be much more aggressive. You'll want to somehow recover that money. So your behavior changes a lot depending on whether you've made profit or loss, even though it's the same amount, right? So that those kinds of biases really come in the way of you realizing the return of the underlying asset, right? वही मैं आपको example बोल रहा था, जैसे मैं बोल रहा था, अगर आपको magically आपको एक stock मिल गया जो बहुत बढ़िया business है, जो over time is going to do well, you'll never actually end up making money, the same amount of money as a stock price का appreciation, because आप गलत time पे उसको sell करोगे, गलत time पे buy करोगे, because आपके biases आपको force करेंगे वो करने के लिए. और ये हर जैसे stock market की रीत नहीं है, ये हर जगह होता है. अगर आप पोकर खेलते हैं, जब आपको एक बैड बीट मिलती है पोकर में, जब आपका which means that your hand was very good to start off with, or your hand was very good in general, but someone else by luck, by chance had a much better hand than you, right? So you get biased by that, and then you start playing in the incorrect manner because you get biased by losing that hand. So it happens everywhere, right? It happens in all spheres of life, and that is why Buffett is saying that investing is simple but not easy, because it is nearly impossible for us to beat our biases, right? I hope I've answered it.
And that's why actually when you look at mutual fund returns, right? जैसे कोई scheme अपने returns publish करती है and it says कि okay, I did 15% return, the scheme or the NAV. Actual investor returns are much lower than that. This is consistently true because they enter at the wrong time and exit at the wrong time. If someone had stayed throughout it, they would do, and it's statistically true, it's 5% का difference होता है, at least 5 to 6% between an investor return and the actual fund they invested in over periods of time. So that is actually what Atanuu is talking about, which is, biases make us, and that gap is human bias.
So would you say staying invested is a great way to go about it, or putting in lump sums every point of time at different points of time is good, or should you do an SIP in a disciplined manner to average down your investments? What is the correct way? And I think
SIP is probably the easiest. See, there are 2-3 things that happen, right? One is, of course, if you, and I think someone talked about it in the chat also, okay, what if every time the market corrects 15%, what if I put a lump sum in? Sure, that's great, right? Absolutely, you can do that. But what that means is that you have to be prepared from that 15% falls another 15% and you're still going to put another lump sum in. If you have the stomach to do it, of course you should. But most human beings, one, don't have the time. No one is sitting and tracking the market every day, and no one has the time to execute so many of those orders, right? If you have a rule that you have made, okay, every day on the 1st of the month, I will come and add some money to my small case, then that's the rule you follow, irrespective of the markets. It's blinkers on. And that's what Warren Buffett says when he says that it's simple, right? It's simple rule banaya. But it's not easy because now you're saying, I'll opportunistically do lump sums. And you might have a busy day at work. You might miss doing it. You might forget about it. You might get scared after another 25% fall. So that's what you're solving for when you say make a simple rule, which is every 1st of every month mein kar raha.
Right. Makes total sense. And I think that answers Nirmal's question as well. If it was like we earlier saw, it is very difficult to time the market. So it is rather better that you do investing in a very disciplined manner and surf through the turbulent times by averaging up or down your investments, right? One question that people would like to know is that, given the current market situation, right, and the markets are correcting, how are you managing that? Like, what factors are you taking into consideration into selecting the stocks, holding them, buying more, or selling some of them? And especially for your Shockproof portfolio, like, have you increased your debt allocation? Have you increased your gold allocation? And within equity as well, how are you managing it, considering the current market scenario?
So, we've developed upside approach. I think we covered it, but upside's approach is that we want tech to be the manager, right? So all our products are run using technology. We don't, we don't actively manage any of our portfolios. We, as in the 3 co-founders, right? So it's the technology taking the decision. And to that end, we made 2 or 3 different algorithms, right? One algorithm reads bottom-up data by bottom-up data, I mean company ki P&L, balance sheet, cash flow, fundamental data jisko kehte hain, and it uses that and parses it and absorbs it and comes up with insights, right? And then there's another algorithm that uses macro data, GDP, inflation, yield, volatility, is type of data, and tells us that okay, in this type of a market, because these are market fundamentals. That's how balance sheet, P&L, cash flow are company fundamentals. GDP, inflation, etc. market fundamentals. It tells us that in this type of market, the most optimum asset allocation is probably this. Itna X equity mein hona chahiye, Y debt mein hona chahiye, Z gold mein hona chahiye. Right? So Shockproof is one product जहाँ हमने ये दोनों एल्गोरिथम को कंबाइन किया है, राइट, जहाँ पे हम वो मैक्रो वाला एल्गोरिथम यूज कर रहे हैं और वो बता रहे हैं कि ओके ये 3 एसेट क्लास में इतना इतना होना चाहिए, और फिर हम हमारा दूसरा एल्गोरिथम यूज करके ये डिटरमाइन कर रहे हैं कि ओके ये इस मार्केट कंडीशन में इक्विटी में ये पोर्टफोलियो सबसे बेस्ट है, राइट. So that's our approach, right? And we rebalance our portfolios periodically. So the algorithm only tells us we feed it data and constantly, and then it tells us that at what point we should tweak the portfolio or change it. Usually on the macro side it is quarterly, because आप आपका जो GDP data है वो quarterly आता है, inflation data monthly आता है, तो by and large most macro parameters quarterly आते हैं, right? So जब वो quarterly आता है तो algorithm वो data absorb करके हमें बताता है कि आप tweak करो data. Fundamental data भी most of the data comes quarterly, but price changes every day, right? So the algorithm, short answer is the algorithm periodically tweaks the portfolio, but that period is not very short. It's not like it's happening in days. It will happen over months or quarters, right? Not days. So that's the approach.
Got it. So when you say that the economic data comes in quarterly and the fundamental data at max on a monthly basis, right? How frequently should subscribers of your small case expect that you rebalance your portfolio? Is there a set, let's say, a monthly rebalancing, a weekly rebalancing, or is it dependent upon the market event? Like, how do you guys manage your portfolios? How frequently do you, check your portfolio composition?
Yeah, so we do that, at least once a quarter. Actually, not at least. Once a quarter onwards, and the previous question where we were talking about asset allocation, वो भी algo जो हमारी backtest थी Shockproof की, वो 2020 में we were sitting 40-45% types in equity, और over the second half of 21 वो खुद ही वो equity का exposure कम करने लग गया था, where at a point we were sitting 30% in gold from December onwards, and that has really helped the portfolio. And the point is कि क्योंकि we're using a system dynamically आप switch कर सकते हो. If you can't do that, then at least खुद करो. नहीं तो of course you can use experts like us to do it. But that was what was happening. The short answer is कि पहले ज़्यादा equity था, वो धीरे-धीरे कम हुआ है. And right now it is sitting at one of the lowest points in equity within the Shockproof portfolio.
Got it. Nimal, is an interesting question that often comes up for especially investors who are well read, and they have this question that gold has consistently underperformed the Nifty index in long term. Does it really make sense to buy gold for a long term investor?
Right. I mean, it depends on what he means by long term, because long term can mean a very different time periods when you look at assets like gold and equity. Because remember, equity is not just Indian equity, right? There is the S&P and Dow have been trading for probably since the late 1800s or early 1900s, right? So I think it's important to know what time period you're looking at. I think the most important thing about gold is not its absolute return numbers, right? The most important thing about gold is that it acts like a natural hedge to equity. अगर आप equity debt और gold को compare करेंगे, उनके return profiles को compare करेंगे, तो equity और debt uncorrelated है. मतलब कि debt को फर्क नहीं पड़ता कि equity ऊपर जा रहा है नीचे. मैं generalize कर रहा हूँ. Of course, in some periods they can move up and down together. Gold is generally inversely related, right? So which means that जब equity ऊपर जा रहा है, gold नीचे जाता है, या vice versa, right? So which makes it a very valuable asset. अगर आप एक पोर्टफोलियो कंस्ट्रक्ट कर रहे हैं, एसेट एलोकेशन का कार्डिनल रूल वही है कि आपको आप जितने अनकोरिलेटेड एसेट्स डाल सकते हैं एक पोर्टफोलियो में, दैट इज रियली गुड फॉर योर पोर्टफोलियो, राइट? बिकॉज़ दैट विल मैक्सिमाइज योर रिस्क एडजस्टेड रिटर्न. तो गोल्ड इज I think has a very different risk return profile than equity and debt, and that is why it's very valuable. And I think if you go and check the numbers, I don't know the number offhand, but if you go and check it over a very, very long period of time, sure, in the last 5-10 years, which has, we've been in the middle of a secular bull run, equities have done really, really well. But if you go and check it over longer periods of time, you'll find that gold's return is very compelling, right? And again, I can't predict this, but we are probably entering very volatile times, right? Or we are in very volatile times when we don't know which way inflation will go. There is war in the world again, right? So, gold is historically viewed as a safe haven, right? When currencies are depreciating, when there's lots of inflation around the world, gold is considered that safe haven. So, gold might surprise you going forward, right? And so, I hope that answers the question.
So basically, the key point here is diversification is the key. And given the asset classes are possibly negatively correlated, it helps with reducing the risk of the portfolio while giving better sleepy nights for people who have a very well diversified portfolio. Great. So, very in the conversation that just we were having, you mentioned that depends upon the period that we're choosing. What is long term, right? So, is there a trend that we see on a rolling basis that what investors should be taking as a time horizon, at least when they're investing in equity products? Is there some data around 1 year rolling returns, 3 year or 5 year rolling returns? Is there like what is the probability of making good money, and hence people should be vying for those time periods at least when investing in equity markets?
Yeah, absolutely. And just on the gold question, right? The other point is what Atanuu was saying about that secular bull run. Up 2009 se dekho, itna paisa has been pumped. The amount of liquidity sloshing around in the world, right? That means that equities have run up a lot. It's been a momentum decade, right? In many ways, isliye momentum strats have done so well. Even on small case, the momentum managers have done really well because money chases money, and momentum ends up doing extremely well. But as liquidity starts leaving the system, how will everything behave? How will equity behave? How will gold behave? Those are all big question marks, and none of us have really seen those cycles, right? So that is what will be interesting to see. Past is no indicator of future performance. That applies to gold's underperformance also. We actually, even I always discounted gold till we built Shockproof and realized what an awesome asset class it is. So sorry, back to your question, Sahil, on rolling returns. I think so a rolling return, what we mean by that is, say I'm considering a period from 2008 onwards. Okay? What I'm trying to see is 1st Jan 2008, if I put money, how would I do that year? Okay? 1st Jan 2008 till 31st December. 2nd Jan 2008, 1 year later. 3rd Jan 2008, 1 year later. That's a rolling 1 year return. Or I keep doing time periods till 2021 to see what are my rolling returns, right? And what you're seeing is on a 1 year basis, your rolling return means you're taking same equity risk, right? Aapka drawdown, jaise agar aapne 2007 se start kiya tha, you will have a year of minus 60%, right? Your average returns will be 11-12% or whatever, but with far more risk. As soon as you extend that time period, up 3-year rolling periods dekho, 5-year rolling periods dekho, which means that you are invested in one strategy, in one manager for much longer periods of time. You will be able to see far more consistent, far better risk-adjusted returns. So if you put money in, say, the Nifty and saw 1 year rolling returns, your probability of a positive year was maybe 70%. You extend that out to a 3-year or a 5-year rolling period, your probability of a positive return is 98%, right? So the only thing that's happened is time, right? Nothing else. In the exact same strategy, just time you give it, you'll end up doing well. And that is why most managers, when they tell you you need to give it time, it's not because they want to hold on to your money for long periods of time, but that's what is good for you, which is to stay invested for longer. And that's why we say do asset allocation, because if you don't, in a bad year, you will leave the market. And that's not what you're supposed to do. The probability of you staying longer increases the more you do asset allocation. So those are the 2 or 3 very important points to take away from this, if nothing else you take away.
Right. And definitely. So the adage that always goes, it's not about timing the markets, but time in the market. So spend as long as you can. Sometimes goal-based investing helps knowing till when do you want to invest.
Absolutely.
Right.
Absolutely.
And that helps you stick for the long term and sticking with your asset allocation, not jumping ships from one strategy to another, one small case to another, believing in the strategy once you decide on it and staying the course, sticking with the course. Right.
Correct.
Shibani has an interesting question, rather a question again that I don't know how we're going to take it, but given that we use AI and it's very much uh, automated, which sector is expected to give good returns in the near future?
Interesting question. So, first of all, I'll be blunt. I don't know, right? Usually in inflationary environments, consumer staples, defensive sectors, what they call defensive sectors, where उसका मतलब ये है कि sectors where अगर आपका fixed amount of पैसा है और every prices of everything are going up, you can't cut some things out of your life, right? You have to buy rice, you have to buy grains, you have to spend money on medicines, but you can not buy, you can defer spending money on buying a new TV, for example, right? So generally in these environments, consumer staples and pharma sectors do well and consumer discretion does not do well. But this is, again, I'm telling you, this is a general thumb rule. I don't know how inflation is going to play out, right? And in fact, I want to use this opportunity to tell you something else, right? Even if I would magically know in the next 100 years that some sector is going to do well, right? I'll give you an example of that. In the 1920s, this is not, by the way, it's not my example, it's Buffett's example. In the 1920s, everyone in the world knew that the future of mobility is automobiles, right? People knew that, and they were probably correct. They are correct, right? 100 years later, the number of cars that are there in the world is humongous, right? It's a huge market. And because of that, there were about 2,000 companies that were auto companies at some part of the auto supply chain. Cut to 2008, and only 3 companies survived, out of which 2 were nearly bankrupt, right, in the US. So the point I'm making is just knowing what a good sector is not sufficient to invest, right? You need to, there's a lot more that goes into it. Current players in that sector might not survive, right? Other players might come in, they might get disrupted, right? So I think, again, I'm not a big fan of investing behind certain sectors and overweighting certain sectors in your portfolio. That is why, even though tech companies in the US are great, I would never say that you should put all your money in the tech sector, right? You should be diversified even across sectors for that reason. So I hope I answered both parts of the question. I told you what does well in inflationary environment generally, but again, it's very hard to predict how inflation is going to play out. And second, even if you knew it, I would recommend not betting on certain sectors for the long term, right? You don't know how the companies within that sector will behave.
Interesting how your answer actually answers the next question as well, which was exactly on if I want to invest for a long term, like 30 to 50 years. By the way, kudos if you can do that, Neelam. Generally, even if we do 3 to 5 months, people just jump ships. But if you do 30 to 50 years, definitely we are sure that you're going to make great money. So she asked that if I want to invest for long term, like 30 to 50 years, then what are the sectors which must be considered to invest into? So I think that really the answer that you gave actually already answers the question. If you want to add something more, please do.
Yeah, not just that. Actually, if you want to invest for 30 years now, buy an index, buy the Nifty. क्या होता है? Nifty is natural selection, where companies that are doing well, sectors that are doing well keep getting added, losers keep getting removed. Right? तो वो naturally जो आप बोल रहे हो वो होते रहता है. So if there was a company in there that Yes Bank is in the Nifty, is going defunct, it leaves. Something else gets added. Right? So and that is the whole point of an index, which is it is tracking your country over long periods of time. So if you have 30 years to invest, buy an index, and so then you're taking a bet on India, all right? And that's the best way to play.
Got it. So Neelam, you are just the right customer for us. If you are investing for 30 to 50 years, definitely I would suggest leave.
Of course. Or give us money. We'll manage it for the next 30 years. No problem.
Would love to have you. Right. Okay. I think we'll just take the last question by Nirmal. Which is an interesting question that we haven't touched upon yet, is that should Indians invest in funds which have holdings in US stocks, and does your small case invest in US stocks?
Yes, you absolutely should. If say you bought lots of India equity exposure, you are exactly perfectly diversified. You follow the plan to the T. You've actually forgotten a very, very big risk you're taking, which is country risk. That means all of your money is in India, and everything that happens to India affects you directly. It is just like we talk about diversification. There's many different ways to do it, right? Our market cap pe karte ho, large, mid, small. आप managers भी करते हो कुछ पैसे. I don't manage all your money. You'll have 2-3 other people who do it. आप कुछ tech में करोगे, कोई non-humans में करोगे, non-humans जैसे 1000 पीस होते हैं. Country diversification is very, very important. You should be investing in US funds. Now, there are great ways to do it. There are lots of mutual funds. Yes, we want to start offering US as well. Just waiting small case to enable that feature. And when they do, we'll be able to offer US stocks to you as well.
Definitely. So guys, stay hooked to small case, and we'll have good news coming in whenever it comes. Be sure that we'll be publicizing it, and Upside AI will launch their small case as well. Okay, thank you so much everyone for joining us. Thank you, Kanika. Thank you, Atanuu. And before we close, just would love to tell everyone that they represent Upside AI. Do check out their small cases on upsideai.smallcase.com. They have talked about all the 3 small cases they have, and they are also running a discount code for all the people who are watching this video. The code is AMA50. Do check out their small cases on upsideai.smallcase.com. Any closing notes, guys, before we close this off?
Yeah, I'll just add something. People have started investing a large number of people have started investing recently, right? So they feel like they've seen the market fall and come back, right? Because they've seen the 2020 fall and come back. All I want to say is that should not be your expectation, right? Today, if the market has fallen 20%, your expectation from a portfolio should not be that it will recover all the losses in 3 months or 6 months. It might happen, but history tells us that it usually takes longer to do it. So sometimes you have to be patient with the portfolio and allow it to make money for you, right? And I think your time horizon should be in years and definitely not in months or even weeks or days or whatever, right? So I think don't let recent history bias you. The stock market history tells us that cycles are longer than a few months or a few weeks, right? And that's all I'll say.
Kanika, any closing notes before we close this off?
No, I think Atanu's summarized it very well for all of us. Thank you so much, and we really enjoyed answering your questions.
Thank you everyone for joining us and taking out time on a Thursday. Thank you so much.